Life insurance is a fundamental pillar of financial planning, providing a safety net for loved ones and businesses alike. In today's complex financial landscape, informed decision-making is paramount, especially with life insurance. Life insurance death benefits are generally not taxed, ensuring beneficiaries receive the full intended amount. Understanding the tax treatment of lifetime benefits is crucial for maximizing the value of your life insurance policy. Surrendering a life insurance policy involves giving up the policy in exchange for its cash value with specific tax implications. Section 1035 of the Internal Revenue Code offers a powerful tool for managing your life insurance portfolio without incurring immediate tax liabilities. The transfer for value rule can have significant tax implications when a life insurance policy is transferred for valuable consideration. Understanding tax-free exchanges and transfers is paramount in estate planning and business succession strategies involving life insurance. Life settlements offer an alternative to surrendering a life insurance policy, providing a lump sum payment that exceeds the policy's cash surrender value. Accelerated death benefits provide a lifeline for terminally ill individuals, offering access to a portion of their life insurance death benefit while still alive. Viatical settlements provide a way for individuals with terminal or chronic illnesses to access funds to cover medical expenses and other financial needs. Buy-sell agreements are essential tools for businesses with multiple owners, ensuring business continuity and a clear roadmap for future ownership.
Entity purchase agreements, also known as stock redemption agreements, offer a straightforward approach to buy-sell arrangements. In this type of agreement, the business entity itself is obligated to purchase the deceased owner's shares. This arrangement simplifies the process and ensures that the ownership remains consolidated among the remaining owners. One of the key advantages of an entity purchase agreement is its simplicity. Since the business entity is the buyer, there's no need for individual owners to purchase life insurance policies on each other. Instead, the business obtains a single policy on each owner, naming itself as the beneficiary. This approach streamlines the process and reduces administrative burdens. Another advantage is that the surviving owner's basis in their business interest increases proportionally to their ownership percentage of the deceased owner's interest. This can result in potential tax advantages for the surviving owners when they eventually sell their shares. However, entity purchase agreements also have potential drawbacks. One consideration is the cost of funding the agreement. The business is responsible for paying the premiums on the life insurance policies, which can be substantial depending on the age and health of the owners and the value of the business. Another factor to consider is the potential tax implications for the surviving owners. When the business uses life insurance proceeds to purchase the deceased owner's shares, it can result in a larger taxable gain for the surviving owners when they sell their interests in the future. Section 3. Cross-purchase agreements and their nuances. In contrast to entity purchase agreements, cross-purchase agreements involve individual owners purchasing life insurance policies on each other. This means that each owner is responsible for maintaining a policy on every other owner, naming themselves as the beneficiary. While this approach can be administratively more complex, it offers distinct advantages in certain situations. One of the key benefits of a cross-purchase agreement is that it allows the surviving owners to increase their basis in the business. When an owner purchases a life insurance policy on another owner, the death benefit received is used to purchase the deceased owner's shares. This increases the surviving owner's cost basis in the business. potentially reducing their capital gains tax liability when they eventually sell their shares. Another advantage is that cross-purchase agreements can be more flexible than entity purchase agreements. For instance, they allow for unequal ownership interests, where owners can purchase different percentages of the deceased owner's shares based on their individual circumstances and financial capabilities. However, cross-purchase agreements can become administratively complex as the number of owners increases. Each owner needs to maintain multiple policies, which can lead to higher administrative costs and potential for errors or oversights. To simplify the administration of cross-purchase agreements, businesses can utilize trustee agreements. In this arrangement, a trustee is appointed to manage the life insurance policies and handle the purchase and distribution of shares upon a triggering event. This approach centralizes the process, reducing the administrative burden on individual owners. Section 4. Wait-and-see agreements, a hybrid approach. Wait-and-see buy-sell agreements, as the name suggests, offer a hybrid approach that combines elements of both entity purchase and cross-purchase agreements. This type of agreement provides flexibility and allows the parties involved to defer certain decisions until a triggering event occurs. In a typical wait-and-see agreement, the business entity is given the first right of refusal to purchase the deceased owner's shares. If the business chooses not to exercise its option, the surviving owners are then given the opportunity to purchase the shares. If the surviving owners also decline, the business entity is typically obligated to purchase the shares. This approach provides flexibility for the business and its owners. It allows the business to retain the option to repurchase shares, potentially keeping ownership consolidated, while also giving the surviving owners the opportunity to increase their stake in the business. Wait-and-see agreements can be particularly beneficial for businesses facing uncertainty about future ownership, or those anticipating potential changes in the business environment. They provide a framework for addressing ownership transitions while allowing for adjustments based on the specific circumstances at the time of the triggering event. However, wait-and-see agreements can be more complex to draft and implement than traditional entity purchase or cross-purchase agreements. They require careful consideration of various factors, including the valuation of the business, the funding mechanism, and the decision-making process in the event of a triggering event.
Section 1. Introduction to Non-Qualified Deferred Compensation Plans. Non-qualified deferred compensation, or NQDC plans, play a crucial role in attracting, retaining, and rewarding key employees, particularly in today's competitive job market. Unlike qualified retirement plans, which are subject to strict regulations and contribution limits, NQDC plans offer greater flexibility in tailoring benefits to the specific needs of highly compensated executives and other key personnel. These plans allow employers to provide additional compensation to select employees, deferring a portion of their earnings to a later date, typically retirement. This deferral can offer significant tax advantages for both the employer and the employee, as the deferred compensation is not taxed until it is actually received. NQDC plans are particularly attractive to executives and highly compensated employees who have maximized their contributions to qualified retirement plans, such as 401 or KKS, and are seeking additional tax-advantaged savings vehicles. By deferring a portion of their compensation, these individuals can potentially reduce their current tax liability and accumulate wealth on a tax-deferred basis. However, it's important to note that NQDC plans are subject to specific rules and regulations, including those outlined in Section 409A of the Internal Revenue Code. These rules are designed to prevent abuse and ensure that the plans are used for their intended purpose of providing deferred compensation. Understanding these rules is crucial for both employers and employees to avoid potential tax penalties and compliance issues. Navigating the types of NQDC plans. NQDC plans come in various forms, each with unique features and benefits. Two common types are salary reduction plans and salary continuation plans, or CRPs. Salary reduction plans allow employees to defer a portion of their current salary. This deferral reduces taxable income, resulting in tax savings. Deferred compensation is paid out at retirement and taxed as ordinary income. CRPs provide additional retirement benefits without reducing current salary. Consulting with a qualified financial advisor is essential. Section 3. Funding arrangements for NQDC plans. Funding arrangements for NQDC plans vary depending on the employer's financial situation and risk tolerance. There are three main funding methods: unfunded, informally funded, and funded. Unfunded plans are not backed by specific assets, posing a risk if the employer faces financial difficulties. Informally funded plans set aside assets but are not protected from creditors. Funded plans place assets in a trust, offering the highest security. Section 4. Tax implications and considerations for NQDC plans. Understanding the tax implications of NQDC plans is crucial for compliance and tax efficiency. Key concepts include constructive receipt and Section 409A rules. Compliance is essential to avoid significant tax penalties. Expert guidance ensures compliance and optimizes tax benefits.
Section 1. Mastering life insurance for a secure future. In today's complex financial landscape, mastering advanced life insurance concepts is not merely an option, but a necessity. As we've explored throughout this comprehensive guide, life insurance is far more than just a death benefit. It's a versatile financial tool that can be strategically employed to safeguard your loved ones, secure your business, and enhance your overall financial well-being. From understanding the nuances of taxation on death benefits and lifetime withdrawals, to navigating the complexities of policy exchanges, transfers for value, and life settlements, knowledge is your most powerful asset. Armed with this understanding, you can make informed decisions about your life insurance coverage, ensuring it aligns seamlessly with your evolving needs and long-term financial goals. Moreover, we've delved into the critical role life insurance plays in business succession planning. Whether you opt for an entity purchase, cross-purchase, or wait-and-see agreement, a well-structured buy-sell agreement funded by life insurance can ensure a smooth transition of ownership, preserving the legacy you've worked so hard to build. Remember, life insurance is not a one-size-fits-all solution, but rather a personalized strategy tailored to your unique circumstances. By embracing the knowledge gained from this guide, you empower yourself to make informed decisions, securing a brighter and more financially secure future for yourself, your family, and your business. Seeking expert guidance for optimal outcomes. Seek guidance from qualified professionals for life insurance planning. Financial advisors, tax professionals, and estate planning attorneys have the expertise to align your strategy with your goals. They help determine coverage, assess risk, and integrate insurance into your financial plan. Advisors provide insights into investment options within your policy. Tax professionals minimize tax liabilities associated with life insurance. They advise on tax implications of policy types and withdrawals. Estate planning attorneys draft buy-sell agreements for business owners. They also advise on trusts and minimizing estate taxes. Assemble a team of trusted professionals for confident financial decisions. Seek expert guidance for financial security and peace of mind.